Jean-Claude, it's up to you.
Thank you, Jean-Claude. Just a few words on the markets next year. The future is not obvious at all after the election of President Trump, as he has such an influence from a geopolitical viewpoint, but also on the economy and on the markets. And he has an influence not only on trade, as you mentioned, but also on immigration, which is so important for inflation. However, we can anticipate, and I apologize not to be very original, one scenario for Europe and two for the US. And maybe as a surprise, a third one for the US. For Europe, one scenario only, in my view, which is a continuous, very slow growth of 0.9 to 1% next year, and inflation around 2%. Europe will be, on top of all, affected by the US tariff and by the Chinese markets for its exports. ECB will continue to cut rates after the deposit rate of 3% down to 2%, 1.5% maybe, and at the same time, the Fed will slow down the pace of interest rate cuts to a median rate of 3.5%, which will reinforce the dollar, which is very bad for the emerging countries, of course. Europe is faced by many diseases. Economic growth in Europe has been only 1/3 of the US since the pandemic and is tarnished by the absence of capital markets unions, the aging workforce, a declining labor force, low productivity, lack of energy, low investments in technology, a missing true single market, and therefore the difference between the US and Europe will widen. In addition, Europe is faced with the risk of public debt, in France in particular. In brief, the outlook for Europe is rather dark, and the European stock markets, in spite of relatively good earnings per share, will remain dull and much less attractive than the US market, of course. In the US, we have two scenarios. First, one booming, already in place, called the Trump trade, with good results of companies, a robust consumer spending, reduced taxes, deregulation, M&A, already fueling the stock market. The US enjoy a growth of 3%, with an unemployment of 4.1% and an inflation of 2.7%, with the SSP having increased by 26% this year, with a strong dollar reinforced by the flow of hot money investing in the US. Growth next year should be around 2.4%, twice the Eurozone growth. Investors of all the world will continue to bet on the US, and especially if compared to a declining Europe, which I mentioned before, and also to a China much less attractive. 300 billion euros are invested from Europe each year in the US. Financial markets, particularly in the Magnificent Seven, which are worth $18,000 billion market cap, and which contribute to 50% of the US stock market gains. The market cap of the US represents 50% of the world market cap, 3 times the European market cap. And as we know, the US benefit of a large united consumer market, the contrary of Europe, high productivity in tech sector, financial resources, leadership in technologies, cheap energy. US labor productivity has grown by 30% since the 2008 financial crisis, more than 3 times the pace in the Eurozone and the UK. The productivity gap since a decade is reshaping the global economy. Now, the second scenario is at the opposite, is much less rosy, with a risk, very important, of resurgence of inflation next year. Yes, Fed is likely to cut its interest rates December 18th by a quarter point. But afterwards, because of Trump policy, a rebound of inflation is likely to happen because of restrictions on immigration and deportations, which will increase the wages. And because, of course, of higher trade tariffs and due to a huge trade deficit. These three factors, plus a low employment and unemployment, will create an overheating and therefore a slower easing cycle, if not later, an increase of interest rates in the US. Yields on 10 years treasuries are now up at 4.4% already. We can anticipate then a high debt, a stock market down, or at least bumpy, the end of the US soft landing, and a great instability. In addition to those scenarios, the level of global debt, public debt, is at $100 trillion, and the geopolitical risk increase the uncertainty and makes us, as Jean-Claude mentioned, more cautious, especially as a bad US scenario could contaminate the world economy in a vicious circle. But to conclude, what is likely to happen in the US is a third scenario, with a rather good beginning of Trump presidency, and then 6 months later, a more unstable and risky period. Thank you.
Thank you very much indeed, Jean-Claude. You take no risk because you have three scenarios on the US. On Europe, unfortunately, you are mentioning only one scenario, which is rather sad, obviously. So